Kadena's black KDA token vaporized after core organization abruptly ceases operations, citing market conditions. On Tuesday, October 21, 2025, the Kadena organization, the core entity behind the Layer 1 Kadena blockchain, announced it was ceasing all business operations and active maintenance, effective immediately. The team cited unfavorable market conditions as the primary driver, stating they were no longer able to promote and support the adoption of the network. The native token, KDA, reacted instantly and violently. The price plummeted more than 60% within 24 hours, collapsing from approximately 22 cents to a new all-time low of around 8 cents. The panic triggered a massive surge in trading volume, which exploded by over 1.200% to more than $120 million as investors rushed for the exits. The outgoing team emphasized that the Kadena blockchain, being a proof-of-work (POW) network, is not owned or operated by them and will continue to function as long as independent miners and community developers maintain it. The KDA community and investors responded with a mix of shock, panic, and intense anger, with many labeling the sudden departure an exit scam or a profound betrayal of trust, especially as the team had been promoting ecosystem grants just days earlier. The collapse marks a tragic end for a project once valued at over $27 billion at its peak in November 2021. The KDA token is now down more than 99.7% from its all-time high, turning billions of dollars in market capitalization to dust. In the unforgiving world of cryptocurrency, trust is the most valuable asset, and it is often as volatile as the tokens themselves. On October 21, 2025, the Kadena community learned this lesson in the most brutal way possible. In a stunning announcement posted to its official X, formerly Twitter, account, the Kadena organization, the central nervous system of the entire project, pulled the plug. The statement read, "We regret to announce that the Kadena organization is no longer able to continue business operations and will be ceasing all business activity and active maintenance of the Kadena blockchain immediately. We are tremendously grateful to everybody who has participated in this journey with us. We regret that because of market conditions, we are unable to continue to promote and support the adoption of this unique decentralized offering." The message was cold, abrupt, and final. There was no winding down period, no detailed transition plan for the community, and no clear financial disclosure. For a project that had raised significant capital and boasted founders from financial titans like JP Morgan, the sudden capitulation was as shocking as it was devastating. The market's response was not one of deliberation, it was a pure, unadulterated panic sell. The 60-minute charts for KDA painted a picture of a project falling off a cliff. The token, which had been trading in a low volatility range around 22 cents, instantly nosedived. Within hours, it had breached 10 cents. By the time the dust began to settle 24 hours later, the price had hit a new, horrifying all-time low of approximately 8 cents, wiping out over 60% of its already decimated value. This event is more than just another token crash, it is a case study in project failure. The fragility of centralized governance in supposedly decentralized systems, and the catastrophic consequences of a prolonged crypto bear market. The financial implosion of KDA was a textbook example of a confidence crisis. The moment the announcement hit social media, automated trading bots and panicked investors initiated a cascade of sell orders. The price drop was not a gradual slide but a vertical descent. KDA was trading steadily in the 20 cents to 23 cents range. Within the first 90 minutes of the news breaking, the price had already fallen by nearly 50%, crashing through psychological support levels without pause. The token eventually bottomed out at a new all-time low, fluctuating between $0.078 and $0.087. This represents a staggering loss of over 60% in a single day. To put this in perspective, KDA's all-time high during the 2021 bull market was $27.64. A $10 investment at the peak, after this crash, would be worth approximately $3. This collapse has effectively vaporized over 99.7% of the token's peak value. As the price collapsed, trading volume went parabolic. According to data from CoinMarketCap and CoinGecko, KDA's 24-hour trading volume surged by over 1.200%, rocketing from a daily average of $5-10 million to over $123 million. This was not, buy the dip, volume. This was a desperate stampede for the exits. The massive increase in volume represented long-term holders, ecosystem participants, and even speculators liquidating their positions at any available price, willing to accept catastrophic losses just to get out. The buy-side liquidity was completely absorbed, leading to massive slippage and accelerating the price crash. Major exchanges like Binance, KuCoin, and Bybit saw their KDA order books saturated with sell orders, flashing red across trading terminals. This market action signals a complete and total evaporation of investor confidence. The sellers were not just trimming positions, they were treating the token as if its value was on a trajectory to zero. The Kadena organization's sole explanation for its dissolution was market conditions. This vague phrase, while common in corporate failures, masks a deeper, more complex reality that has plagued the crypto industry for the past 2 years. Like most Layer 1 foundations, the Kadena organization's treasury was likely heavily denominated in its own native token, KDA. When KDA was trading at $27, this treasury would have been worth billions, providing a seemingly endless runway for development, marketing, and ecosystem grants. However, as KDA's price bled out by over 99% before this final crash, the treasury's value would have evaporated with it. A $1 billion treasury at the peak would have shrunk to less than $10 million. This is insufficient to maintain a global team of developers, marketers, and executives, especially those with backgrounds from Wall Street. Kadena launched in 2019 with a compelling narrative. It was founded by Stuart Popejoy and William Martino, who led JP Morgan's first blockchain group and had experience at the SEC. Its technology, a sharded proof-of-work consensus mechanism called Chainweb, promised to be infinitely scalable while maintaining the security of Bitcoin. It was aimed at attracting serious enterprise adoption. The problem? The enterprises never came, and in the race for developer and user adoption, Kadena was lapped by competitors. Newer, flashier Layer 1s like Solana, Aptos, and Sway, along with the burgeoning ecosystem of Ethereum Layer 2s, like Arbitrum and Optimism, captured the vast majority of developer talent, venture capital, and user attention. Kadena's ecosystem remained a ghost town, with few notable DApps and thinning user activity. The crypto winter that began in 2022 was not just a price correction, it was an extinction-level event for projects without a sustainable business model. The era of easy money and venture capital funding dried up. Projects were forced to survive on their own merits. And Kadena, lacking a vibrant user base and fee-generating applications, had no real revenue. The market conditions it cited were, in reality, the project's inability to survive in an environment where hype was no longer enough to pay the bills. While the financial markets reacted with panic, the social markets, Discord, Telegram, and X, reacted with pure rage. The Kadena community, which had supported the project through a 99% price decline, felt profoundly betrayed. The term, exit scam, was immediately leveled against the founders. Critics pointed to the fact that the Kadena team had been actively promoting its grant programs and holding hackathons just days before the announcement. This gave the impression that the team knew of the impending shutdown but continued to encourage community participation, only to pull the rug out from under them. Accusations flew that the core team, having unlocked their own vested tokens, were simply walking away from a failed project, leaving retail investors to hold worthless bags. The lack of transparency was the key driver of this anger. A structured wind down, a public audit of the treasury, or a detailed plan to transition power to a community-led DAO, decentralized autonomous organization, could have softened the blow. Instead, the community received a curt social media post. This handling of the situation has been criticized as a masterclass in how to destroy a community and permanently tarnish the reputations of its founders. The potential for class action lawsuits is already being discussed among an investor base that feels it was misled and abandoned. The Kadena organization's final defense is that the blockchain itself will live on. Technically, this is true. As a proof-of-work chain, the Kadena network is maintained by a global, decentralized base of miners who validate transactions. The team has promised to release a new binary that will allow nodes to operate without the organization's involvement. However, a blockchain is far more than just its consensus mechanism. It is a living ecosystem that requires: who will write and implement crucial security patches? Who will fix bugs? Who will manage future upgrades to keep the protocol competitive? Without a foundation to provide grants, marketing, and business development, there is zero incentive for new developers to build on Kadena. As the KDA token's value collapses, mining profitability plummets. This will inevitably cause miners to shut off their machines, leading to a decrease in the network's hash rate. A lower hash rate makes the chain more vulnerable to a 51% attack, where a malicious actor could seize control of the network, halt transactions, or double spend coins. The team has essentially abandoned the network and left it in the hands of a demoralized and fractured community. While a passionate group of volunteers may try to keep the project alive, the reality is stark. Kadena is now, for all practical purposes, a ghost chain. It may continue to process blocks, but it will be a digital relic, devoid of growth, innovation, or a viable future. The collapse of Kadena is a tragic but necessary lesson for the cryptocurrency industry. It serves as a stark reminder that Kadena's hybrid POW technology was genuinely innovative, but without adoption, a user base, and a viable ecosystem, superior tech is worthless. The KDA token was marketed as a decentralized asset, but its fate was entirely tied to a single, centralized organization. When that organization failed, the entire ecosystem collapsed. This highlights the dangers of team-run projects that masquerade as decentralized networks. The 2022-2025 crypto winter has been a painful but effective filter, separating projects with real utility and sustainable models from those that were merely surviving on bull market hype and VC funding. For the thousands of investors who held KDA, this event is a personal financial disaster. For the broader market, it is another deep scar on investor confidence, reinforcing the Wild West reputation of the crypto space. The Kadena story has concluded not with a bang, but with a whimper, a curt X post and a 60% red candle that serves as its tombstone.